Good morning. These are the things that matter most in Europe's market today. Alphabet's AI spending lifts the global tech mood. Oil reaches a 6-week high as the Red Sea and Iran risk premium grows. The yen remains near multi-decade lows, and a quieter logistics real estate signal asks whether Europe is still pricing growth too generously. The central market question is this: does Europe open with broad risk appetite? Or does the session split into AI infrastructure winners, energy beneficiaries, and pressure on transport, carmakers, and rate-sensitive real estate? Start with the AI handoff. Alphabet's results in AI spending helped Asian markets trade higher, while Investing.com reported long-term Intel and AMD server CPU deals with Chinese buyers. For Europe, this is not just a U.S. megacap story. It is a proof test for the public market AI supply chain. Chip equipment, power, data centers, automation, and software. The cleaner side is ASML, Infineon, STMicro, SAP, Siemens, and Schneider Electric if investors see AI demand broadening into European suppliers. Pressure sits with companies that only carry an AI label, or with hardware names where China exposure becomes a political or margin risk. For private investors, the takeaway is simple: do not chase the word AI. Watch whether the European value chain confirms revenue, pricing power, and order visibility. The second story is energy and geopolitics. Oil moved to a 6-week high. Investing.com reported another night of U.S. strikes on Iran, and Houthis claimed attacks on Saudi tankers in the Red Sea. Europe has to price this as a split market, not one clean risk-on or risk-off signal. Potential beneficiaries are Shell, Total Energies, BP, and selected energy security exposure if crude strength is confirmed. Pressure sits with Ryanair, IAG, Lufthansa, BASF, chemicals, transport, and consumer names if fuel and input costs become the bigger story. For private investors, the useful filter is divergence. A stronger oil price can help producers and hurt margins elsewhere at the same time. The third story is currencies. A Reuters poll carried by Investing.com said the Bank of Japan is expected to raise rates again by December as the weak yen revives inflation risks, while the yen stayed near a 40-year low. For Europe, this matters because carmakers, luxury, machinery, and industrial exporters all sit inside the yen and Asia demand map. The cleaner side is companies with pricing power, local cost control, and differentiated technology. Pressure sits with Volkswagen, Stellantis, BMW, Mercedes-Benz, LVMH, and Kering if investors connect yen weakness or Asia demand uncertainty to margins. For private investors, this is not a foreign exchange bet. It is a way to test whether Europe's exporter basket is resilient or vulnerable. The underappreciated story is European logistics real estate. The Guardian reported that Segro's board made a U-turn on a £14 billion takeover bid by Prologis. That is not the loudest morning headline, but it matters because logistics property sits at the crossroads of interest rates, e-commerce, industrial demand, and balance sheet confidence. Potential winners are high-quality logistics assets and companies that can fund growth without stress. Pressure sits with leveraged real estate, weaker REITs, and domestic cyclicals if the market reads takeover interest as scarce growth rather than broad sector health. For private investors, the takeaway is valuation discipline. A takeover headline can be supportive, but real estate still needs rate expectations, rent growth, and financing conditions to confirm. Here is the stock-led watch list. ASML, Infineon, STMicro, SAP, Siemens, and Schneider Electric test whether the AI handoff becomes broad European proof. Shell, Total Energies, BP, Ryanair, IAG, Lufthansa, and BASF test whether oil is a producer benefit or a margin problem. Volkswagen, Stellantis, BMW, Mercedes-Benz, LVMH, and Kering test the yen and Asia demand read-through. Segro, Vonovia, British Land, and European logistics property names test whether real estate strength is selective or broad. Aston Martin, UK retailers, and travel names add a consumer balance sheet cross-check, but the main signal is whether AI, oil, yen, and real estate confirm together. Market bias, constructive but highly selective. The global setup supports risk appetite. Asia is firmer, and AI infrastructure still has momentum. But Europe also faces oil pressure, currency distortion, and rate-sensitive balance sheet tests. The mistake to avoid is turning every important headline into an investable signal. Today is a confirmation day. Watch breadth, margins, financing conditions, and company-specific resilience before drawing conclusions. That is the Europe Morning Market Brief. We will be back tomorrow at the same time with everything that matters. Research context only. This briefing is not investment advice. It is not a recommendation to buy, sell, or hold any security, and it does not include price targets, stop losses, position sizing, or personal financial advice.